Welcome to TheoTrade. This is Don Kaufman. It's March 21st, 2025. There are just seconds to go to the cash close here on this triple witching Friday with the S&Ps, well, massively unchanged. For the most part, it's a fairly quiet week. But look, that's all on the surface, right? It's just calm on the surface. But this marketplace, it just reeks of risk kind of still lurking. And I'm going to explain exactly that and much more here, of course, on this TheoTrade weekend update. Let's get right into it here. Look, as I was saying seconds ago, there are, well, seconds left to the weekend over here with a little bit of a bid back under the marketplace. There's no surprise. You know, when nothing's happening, you get a little positive drift over here, but it does seem unusually quiet. Not because it's like a triple witching. It seems unusually quiet, okay? For the bottom line, look at the expansive move that we were kind of anticipating throughout the course of this week. There is the closing bell. Throughout the course of the week, we're anticipating this basically $140 move, okay? And I want to start here, this $140 move that you're kind of anticipating. Actual move, negligible. I mean, it's not even worth like mentioning, like, well, we finished up. Okay, look, the rally that really kind of kicked off last Friday did not grip hold, not in the least. I mean, yeah, you had a little bit of a bid back under us on Monday, but we gave it all back on Tuesday. And on Wednesday during the Fed, we rallied, we faded. On Thursday, we rallied, we faded. Here we are on Friday. What do? Not a whole hell of a lot. Again, for an expiration, it's tight. And what I see in here is what I would actually term some volatility compression. I'm going to actually explain a little bit more about that and actually show you exactly what it means. But for the most part, you got a marketplace that's just getting like pressure literally from both sides. Everything kind of calms down for a period of time. This is not necessarily a good thing. Okay, we're getting all bottled up at this point, and volatility is going to rip, and that's exactly what I'm going to show you here momentarily. All signs still point to heavy volatility ahead. And there's a bit of a catch-22 though in there, and I'm actually going to show you exactly that. Some people are going to be like, no, volatility is backed off. Well, I'm going to show you again, specifically what I look at for indications of volatility. And again, they are still unequivocally displaying quite a bit of risk. So this entire week, look, there's not much to mention in here. You know, you're stuck in the middle with the SPOOs. It's been, I don't want to say, a quiet week, because we have had quite a bit of volatility. I mean, there's just no question. Trade it's been fast, it's been sketchy, it's been broken, it's been disconnected. The advanced decline line has done everything from correlate to go back to 50-50. Like it's got, let's get crazy. And the S&Ps were down, some 50 handles. Look at the range today. The range has been 70 points from low to high on the day. That's not a quiet week by any stretch of the imagination, but in the end, we ended up for the most part kind of unchanged. If you take a look at the QQQ, I also want to bring up the Nasdaq here for a second. Again, does this look like a rally? And just ask yourself and be objective. Does it look like a rally? All right. In fact, I'll even apply auto expected moves. Does this look like a rally? Even on Friday, last Friday, the rally back here was kind of meager. And this week has been completely flat, but sizable ranges in here. And the answer that I have for that, no, it doesn't look like a rally. Could there still be some upside potential in this marketplace? Unequivocally, the answer is yes. Okay, just because I say there's going to be volatility, it's not necessarily like a huge negative. So there could still be some upside opportunity. And again, here in the QQQ, but largely, okay, I want you to understand, even if there is upside, okay, you're going to get rocked here. We're probably going to retest through the lows. And it might not necessarily be like in the immediate future, like, Monday, Tuesday, but I think you need to anticipate that we're still going to retest through lows. And I'm saying that right off the bat here, okay, or on this weekend update, that, the one thing about volatility, okay, is it's tough to time. That's why people get rocked in volatility. Retail traders, if you're listening right now, and we have a lot of professionals that listen, former market makers that kind of tune in from time to time, and on and on. Okay. But retail traders, they just like a moth to the flame in markets like this. Okay. Got to step back, got to reduce risk, got to use spreads when and where you can. I'll show you a couple of like positions that I'm in. I'm actually going to talk about like Exxon Mobil and TLT and GLD and FXI and EWG. I'm actually going to talk about a few positions that I'm in to give you a feel where, at times, if you're not feeling lovely about the S&Ps, okay, this is not a marketplace that you want to fight. This is not a marketplace that you want to sit in here, okay, and convince yourself, okay, of anything other than the obvious, and that is we've had a 10% kind of correction in the marketplace. Okay, volatility is absolutely unequivocally still on the table, and you could get served up, as the main course. So if you're in positions right now, okay, risk reduction is going to be the key. There's wonderful positions you can take in the midst of this type of volatility as well, but you're going to have to do it. And you're going to have to do it right, okay? And you're not going to try to time things because no one gets it right. Okay, I'm actually going to show you another trade. While I'm at it, I'll even show you the Goldman Sachs trade, which I jumped into a short position over there. You're never going to time it right, but the right style of trade is what's so critical in this. So as I said a moment ago, this volatility kind of compression this week just simply means, well, exactly what it sounds like. The markets, okay, kind of settled in, all right, in terms of the overall volatility. Now, for those of you, I think a lot of people still look at VIX. Okay, VIX is kind of like an ancient tool. So the volatility in the VIX is actually backing off. And as I said a moment ago, like volatility in the VIX to me is just that. It's kind of an ancient tool. I'm not into it. The VIX uses a 30-day average inside of the SPX. I just did a full class on this. Literally today, I did a full class on this. So the VIX is an equation, and the equation is based on options that trade, okay, all the way out here in and around like the 30-day mark. Okay, and if you take a look at the options that are really heavily involved, like in VIX, you open them up and you look at something called volume and open interest, right? There is no volume out here. Nobody trades this crap. Okay, so the VIX becomes kind of like a dead instrument. It's volatility. It's surely volatility, but it's not a good pulse on it because you look at like this is the options that expire today. There's tens of thousands of contracts in every single strike. You even look at like the Monday options. Okay, there's thousands and thousands of contracts in every single strike that's traded. This is in the SPX. So the VIX is not a great instrument. And yeah, the VIX actually backed off. But there's another way to look at the VIX. Yeah, it backed off because we're settling in to the idea, okay, of more risk. And until that risk rears its ugly head again, okay, the volatility should actually collapse back down. The same is actually true of VVIX. And I wanted to get into this, and I wanted to make a quick note about VVIX because I saw a couple of articles about it. People were talking about it. VVIX, the volatility of the VIX itself, has collapsed back down. And people take this as, okay, take off your helmets, put away weapons and ammo. We're done with volatility because the VVIX collapsed back down. On the contrary. Okay, on the contrary. So the VVIX, which is the volatility of the VIX options, the VVIX collapses back down because those that trade VIX options, okay, were relinquishing profitable hedges. And that's what's often missed about this is that, when the VIX initially spiked, okay, the volatility on the VIX also spiked. That's what the VVIX is. And because the volatility in the VIX spiked and the VIX also went up, okay, lots of trading happens, okay, that actually crushes down the VIX volatility. Why? Because what you have is, imagine you have a bunch of calls on the VIX. I bought calls in the VIX and the VIX spikes. What do you then do? You go, I sold my calls in the VIX. Yes. And when you sell your calls in the VIX, supply and demand dynamic, okay, drops the volatility of the VIX itself. This does not though designate, okay, that, it's sounding the all clear. It's not all clear. Okay, it's definitely not an all clear sign. And you can actually see this a number of times in very recent history. The big spikes in the VVIX and then we subside. The big spikes in the VVIX, big spikes in VVIX and big spikes in VVIX and subsides. So I'm going to tell you right now, volatility of the VIX is very likely to go right back up next week as basically what you're going to have, firms are going to come in and rearm themselves with hedges. Okay, so the VIX, comes back down a little bit, but what you're getting here in VVIX, it's displaying that those that had hedges on are kind of relinquishing profitable hedges. Okay, possibly looking for a reload here in the near term. And I wanted to spend some time on the VVIX. That crap's important. The other thing that still points to considerable risk is the volatility future. So I'm a full-fledged volatility. I'm a volatility geek. Okay, I'm self-aware that I'm a volatility geek, and when I look at the volatility futures, this is April, this is May, this is June. Okay, basically the entire vol skew is relatively flat right now, and what that basically implies is, okay, the risk 26 days from now is effectively the same as risk 89 days from now, and that kind of blows my mind. Especially when you start thinking about the administration and all the crap that's gone on. We're going to be turning the corner, and obviously we're in spring here, but we're going to be talking about summer really soon. And 90 days, okay, of like the Trump administration tweeting tariffs, okay, retaliatory tariffs, like that's a lot of crap. And with 89 days, like a lot can happen in 89 days. And that's why I say, like, read between the lines, because the 26-day risk is basically the same as the 89-day risk, which, what does that tell you? It tells you, crap. Like, that's where you should say, crap, I understand what you're saying. If the risk is bad in the next 26 days, as it is 89 days from now, okay, that just means the marketplace is about to get freaky again. Now, I'm not telling you, okay, that has a directional bias associated with it. It's not about directional bias. Okay, it's much more about you're going to get a lot of two-sided trade, and that two-sided trade is definitely going to coincide, okay, with breaking some lows and getting all kinds of crazy. Yes, the market is going to descend lower. It can definitely rally, though. Here in the near term, it can rally back up, but we're actually going to see some significant volatility. Again, when I say I don't want to assign a directional bias, you want to look to both sides of this. You want to understand that the trades that you're trying to employ are going to use, okay, not just like two-sided. They can be bearish, they can be bullish. Okay, your timing's not going to be perfect though in this marketplace. Is the kind of the big takeaway from that. And if you're looking at like rallies like this, we're like, we bounce back over here, we rally a little bit more. Fade it. Fade those rallies is what you want to do. And if we have a wicked and vicious sell-off, okay, we're actually going to buy into that. But we're going to use defined risk. There's no dip buying going on right now. Okay, the dip is going to buy you if you come in and attempt that. So I wanted to cover a little bit about the VVIX, okay, versus those volatility futures, because the VVIX collapsed back down. Again, trading firms relinquishing hedges, but the vol futures still point to considerable risk. All right, the next point over here. Do not confuse this lull in the marketplace, okay, as anything other than, okay, a lull in the marketplace. So this, I put in here, don't confuse this as complacency or this complacency. It's anything but complacent. What you have right now is a marketplace that, you got through the Fed announcement this week. All right, you had some other announcements and it really kind of rocked the markets. By the way, the Fed announcement, it doesn't look like much, okay? But we did have a range from, 57.15, okay, all the way down to 56.20. It's a 100-point S&P range on there. Even though these days, okay, are flat and we feel compressed, like you can still see that this marketplace, it is a moving, okay? The problem that we've got right now is it's also seeking any input. Okay, any type of even small kind of exogenous event, a tweet, or for example, I was looking at this just a few moments ago, like looking at the calendar, something ridiculous like, the PMI composite flash, okay, consumer confidence, that's going to be a big one, consumer confidence, because everybody got scared out of the University of Michigan Consumer Confidence Survey. These consumer confidence surveys are absolutely ridiculous. They're ridiculous. Okay, what do you think about the economy? Oh, I think it's wonderful. You look at like Wednesday. Okay, there's again durable goods on Wednesday. It's another huge one. And it just every day next week, okay, is a recipe for more volatility. And I'm telling you, we're going to latch onto those. Okay. So bottom line, the reason I'm mentioning that is you have to know at minimum, okay, when those announcements are coming out, especially if you're going to trade it all intraday. And then we're going to try to take, positions in and around them because you're going to get a lot of whipsaw movement. If we fly higher, we're going to fade it. Okay. If we get rocked lower, surely going to be able to buy it. Lots and lots of opportunities. Speaking of opportunities, okay, a couple of the trades I've done lately. I'm officially out now of ExxonMobil. Okay, this one's kind of ironic, and the reason I'm bringing up ExxonMobil is to talk about just a lesson in trading. Okay, in fact, here I'll show everybody the trade before I go any deeper into this. In ExxonMobil, what I did was got bullish all the way back. Okay, and again, I'm just showing you a position. It was not a great position. It made money, right? But a position where I put it on February 19th, and I closed it. Okay, this week, March 19th. So the position's on exactly a month. So if I zoom in, okay, and you wanna see exactly like February 19th, okay, it is right in this neighborhood here. And in fact, I'm gonna mark it on your screen. That's February 19th. I got bullish right there. Okay. Market, oh, it almost went up and it almost went up and then it fell flat on its face and everybody was sending me emails and like, your trade sucks because it's bullish. And then we were basically positive and out with, again, over a 55% gain in here. The bottom line is, okay, timing didn't matter in here. Didn't matter. It was about the structure of the trade. And the in-out spread was the only thing that actually put me into the right structure of the trade. Okay, that's critically important. The next trade that I've got on, this one's not closed. This one is still very much open. This is a quintessential, what we term bounce and fade. Okay, this is a huge precipitous sell-off. Here's the bounce. Now we're going to fade it. What does a fade mean? It means I'm looking for it to roll back over. Okay, and I'm just going to tell you right now, I'm on the clock. I got 21 days for what to occur. You can see our open interest stands out like a sore thumb here. You can see I just got to get below 550. Let's get crazy. Let's get below 550. Where's 550 on the chart? 550 on the chart's like right here. That's nothing. As I zoom in over here, I just want you guys to see 550. Okay, that's a nothing burger to get to. That's all I need though to be like fully profitable, and that's so critical. So critical. So that's the in-out spread. And as I was saying, you want to be successful in this marketplace, you got to keep yourself kind of intact like that. You got to go out and you got to put on strategies that even if the marketplace is going to make wild and woolly moves against you, like in Goldman Sachs, okay, be honest with yourself. You're trying to time volatility. We could rock to the upside and then tank. As I said, though, I'm on the clock. I got 21 days to find out. What else do I have on? TLT. Okay, TLT, I put on a bullish position right before the Fed announcement, closed that one profitably. Nice pop to the upside. TLT is over and done with. Okay, GLD. Okay, this is one that, well, some people could still hop on board. In gold, okay, I'm bearish right now. And I'm bearish simply because this thing has had an explosive move outside the expected move, outside the expected move, outside the expected move, looking for a pretty decent pullback in here. So I took a short position, also used define risk on that one with an in-out spread. FXI, again, here's a short position in FXI. This one, the trade is absolutely still on. Okay, the trade is now working, obviously, in my direction. By the way, after hours, sometimes you get some weird quotes in here, but the FXI position down again. This is a marketplace. I want to be clear. I want to be short. I want to be short China large caps. I don't want to hold this for a substantiated period of time. I'm 91 days out. Similarly with EWG, this is a German market. 119 days. Got 119 days for what to happen, for Germany to implode. Okay, I'm not saying my timing is perfect in here. I'm not trying to time it perfectly, but I am saying that I absolutely unequivocally, I want to be short. Okay, in some of these emerging markets, specifically FXI and the German market. By the way, the German market has nothing to do with investment per se in Europe. It has everything to do with the fact that the German Bund, the interest rate associated with it, It's exploding. It's just absolutely exploding. So I wanted to take you in a couple of my positions over here because it's not about, again, the timing. It's just not about the timing, okay? Because if you think you're going to be able to time this volatility, like, look, even the marketplace is screaming to you right now. I'm compressed, I'm angry, not depressed, but compressed. I'm compressed, I'm angry, okay? And I'm ready to blow. And you got to be able to read through that. And that's why I'm saying, everything's kind of calm on the surface. Do you realize, crap, these are 70, 80 point moves every single day. Like, we're going to move. The risk is still kind of lurking in the backdrop over here. With that, last thing I'm going to look at with you here on this weekend's update, of course, is the SPX, the mother of all products, 7 days out. What are we expecting? What are we expecting 7 days out? Okay, looks like we're going to be in and around $109 move. By the way, based on the time frame right here, okay, that time over here does define that is, okay, now the static expected move. That's the static expected move means bring the pain, people. We're still going to see a $109 move. Now, we just moved off of a week that had roughly $140 expected move. So again, along with the marketplace kind of compressed in here, we are now seeing a little bit of compression of the volatility. The volatility dropped. Let's call the volatility drop by 25%. But you don't have a Fed announcement, obviously, this week, okay, this next week coming up. So volatility calms down a little bit. And I'm just going to go ahead and say it. With a $109 expected move, you better anticipate every ounce of that $109 move is coming to a theater near you. As I said again, calm on the surface, risk still absolutely lurking. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.